Welcome to this explainer. Look, today we are bringing you a massive, comprehensive breakdown of the markets. This is exactly the kind of deep, detailed overview you could easily put on during an 11-hour flight to just soak in and really learn how the market mechanics are working right now. We're going to break down every concept practically. We'll start with the high adrenaline microscope view of tomorrow's opening bell, giving you our exact U.S. stock market prediction for tomorrow, along with critical levels and setups. But we're not stopping there. Then we're zooming way out to a telescope view, breaking down a massive portfolio rotation strategy for 2026 used by high net worth investors. It's the micro meeting the macro. So let's get right into it. $70 trillion. Let that sink in for a second. The S&P 500 just hit a truly historic milestone, pushing past a $70 trillion market cap. That means the combined total value of all the companies in the index has crossed that massive threshold, breaking the 7,700 level for the first time ever. It is the 25th all-time high of the year, which, historically speaking, signals incredibly strong forward momentum and virtually guarantees a positive close for the year. It's a total juggernaut.
But here's where it gets wild. The paradox of how we actually got here is fascinating. This staggering market high is paradoxically fueled by intense geopolitical volatility. The futures market absolutely caught fire on this exact quote from U.S. Treasury Secretary Scott Bessent about a potential de-escalation in the Strait of Hormuz. But behind the scenes, we're looking at reports that the U.S. has depleted virtually all its precision missiles and half its global Tomahawk supply. So we are literally seeing record highs riding right on the razor's edge of global tensions. Crazy, right?
Section 1. Big Tech Earnings Volatility. Underneath all those heavy geopolitical headlines, there's a fundamental engine driving this market upward, and it's an unprecedented surge in corporate profits. So, looking practically at the SPY for tomorrow, the ETF tracking the S&P 500, here is your tactical playbook. You absolutely want to watch the 770 to 771 range. That needs to hold as our critical support, our price floor. Because if we break below that floor in the morning, we could see a quick, sharp slide down to $765. But if it holds and pushes past 773.41, we are looking at clear, uncharted air with resistance targets, basically our price ceilings, at 775 and a nice even whole dollar level at 780. Now, the wild volatility we're seeing under the hood is staggering, even with massive earnings beats across the board. Look at SpaceX. They just posted a massive 92% year-over-year revenue jump to $7.8 billion. Then you have Snapchat growing revenue by 19% and generating positive free cash flow, meaning they actually have cash left over after paying all their operating bills. Yet, both of these names have faced wild, completely unpredictable after-hours trading swings. It just proves how erratic and sensitive individual tech names are right now.
Section 2. Tomorrow's top stock setups.
So the crucial point here is knowing your exact technical levels before that opening bell rings. Keep a really close eye on Navitas Semiconductor breaking above $12.85 and Uranium Energy pushing above $10.82 for upside continuations. Now, if the broader energy sector falters, watch Chevron break below $189. But honestly, I want to draw your absolute attention to AG, First Majestic. Someone just placed a massive $725,000 options bet on the $17 strike. That is a huge institutional bet that the stock will shoot well past that $17 mark. Technically, it's breaking out of a long-term downtrend, all supported by falling interest rates and rising silver prices. Definitely one to watch.
Rounding out the watch list to build our broader strategy, we need to keep Oracle heavily on the radar. It's in a very weird spot, actually bouncing despite hitting its highest default risk in history. That means the market is pricing in a high chance they can't pay their debts, making this bounce highly unusual and volatile. Also, keep an eye on Whirlpool, ticker WHR. It is bouncing perfectly off a $36 support level following a massive $990,000 options trade made weeks ago. Finally, track energy names like UNG and XLE super tightly. If that Strait of Hormuz deal falls through, these are primed to run. And hey, just a quick pause. If you are finding this breakdown valuable and want to keep mastering these markets with us, make sure to hit subscribe to Langford Invests. We love building this community with you guys. All right, let's keep going.
Section 3. The Great Portfolio Rotation.
Okay, now that we've covered the tactical, day-to-day moves for tomorrow, let's zoom out to the 30,000-foot view. We're going to look at how a high net worth investor is actively shifting their massive portfolio to not just survive, but thrive through 2026. You see, it is incredibly easy to fall into a psychological trap when markets get this crazy. Take a look at this allocation. 25% sitting in cash and treasuries, Sure, it's yielding around 3.5 to 4.2%, and on paper, it feels incredibly safe, right? But sitting on that much cash fundamentally shifts your mindset from playing to win to playing not to lose. And when you do that, you are actively risking a decade of compound growth simply because you want comfort.
The solution to this cash drag is a massive, proactive portfolio rotation. This investor is dumping that excess cash and funneling it directly into the S&P 500, aggressively dollar-cost averaging on literally any dip. That just means buying steadily over time, no matter if the price goes up or down. But here is the real twist. They are increasing their allocation to international and emerging markets to a whopping 28%. Why do that? Well, international markets have actually outperformed the U.S. recently in this specific portfolio. They act as a vital growth hedge with asymmetric upside. Basically, it gives them very low risk for a massive potential reward if U.S. volatility keeps up.
Section 4. Exiting the real estate trap. We also have to talk about how the old adage that real estate is always the safest bet is fundamentally breaking down right now. In heavily regulated markets like California, the math is just completely broken for small landlords. Insurance costs have more than doubled, repair costs have tripled, and the regulatory environment is so hostile and complex that simply texting a tenant now practically requires a $400 an hour lawyer just to avoid massive litigation over some minor disclosure error. It's a minefield.
To really picture this real-world mediation demand perfectly illustrates the unwinnable legal game landlords face today. Imagine this scenario. A tenant stops paying rent and starts illegally altering the property. During mediation, the tenant literally says, "I'll move out, but you have to give me 4 months to vacate, cash paid up front to leave, a total waiver of all the rent I owe, and a sealed record." And you want to know the absolute craziest part? That tenant's completely outrageous demand is actually mathematically cheaper for the landlord to accept than taking them to a trial they are 100% guaranteed to win.
Just look at the staggering historical comparison here. To put it in perspective, back in 2012, an eviction cost around $1,500 and took maybe 60 days. Today, that exact same process can cost between $50,000 and $60,000. When you're looking at systemic costs like that, pulling your equity out of real estate to buy a 100% liquid, completely safe government treasury becomes an absolute no-brainer. At that point, it's entirely about optimizing capital efficiency and just removing the headache from your life.
Section 5. Alternative assets and Bitcoin. So if California real estate is out of the picture, where else can all that capital be deployed efficiently? Well, for years, Bitcoin was viewed purely as a highly volatile, speculative gamble. But as global government deficits continue to climb and institutional adoption accelerates faster than anyone expected, the whole thesis is fundamentally shifting. Bitcoin is evolving into what we call a portfolio efficiency tool. This means its historic volatility and massive drawdowns are actually diminishing over time. It's offering compelling asymmetric upside that provides non-correlated returns. But simply, it zigs when the rest of the stock market zags. This actually optimizes a broader traditional portfolio rather than just acting like a lottery ticket. And hey, even physical collectibles can act like financial instruments if you pick them correctly. Take exotic cars, for example. A 2005 Ford GT has gained 65% in value, effectively mirroring a reliable index fund's steady climb. But on the flip side, an early 2010 Tesla Roadster lost 30% of its value due to plummeting brand demand and incredibly heavy repair costs. The lesson here is that collectibles like cars, art, or watches can be super fun and lucrative, but they carry massive asset-specific risk compared to a broad index fund.
Finally, we absolutely must talk about the private equity trap. Please do not undervalue simplicity in your investments. It's so easy to look at a spreadsheet and see a startup investment that says you're up 300%. But what nobody tells you is that your money is locked up indefinitely, you face constant dilution from new funding rounds, and actually cashing out is practically impossible. Even if you somehow manage to find a buyer on the secondary market, you might have to take a 70% discount, literally giving up the vast majority of the value just to escape. Never, ever forget that liquidity is king.
So, as you look at the volatility hitting the market tomorrow morning, as you watch the SPY test those 770 levels, as we wait on geopolitical news out of the Middle East and hunt for momentum in names like Oracle and Snapchat, I really want you to ask yourself this critical question. Are your daily tactical trades in true alignment with your long-term strategy for wealth? Are you actively playing to win, or are you just playing not to lose? Think deeply about that as you structure your portfolio for the years ahead. Thanks for joining this explainer, and we'll see you in the next one.